Welcome back to A to Z Equities, where we discuss all US listed stocks from A to Z. Today we're discussing Alcoa Corporation, ticker AA. We're going to be rating this company on 5 different metrics on a scale from 1 to 5 stars. The 5 metrics are industry, price, growth, financial position, and management. After we rate the company on each of these 5 metrics, we will then be assigning a blended total 5-star rating on this company at the conclusion of the video. This video is not financial advice. It is not a buy or sell recommendation on Alcoa. I personally have no position in Alcoa, whether short or long. With all of that said, let's get into the video. So Alcoa is, in terms of its industry, as we can see here on the investor relations page, a global industry leader, primarily in the aluminum industry. This is a very well-known company, tracing its roots back to the 1800s. It's a leader in aluminum and other um, metals production since developing the aluminum industry more than 135 years ago. Alcoa has built a legacy of breakthrough innovations and best practices. So this is very much a commodity-based company that is good in terms of being inflation resistant. The downside, of course, is that commodity prices fluctuate a good deal. So although the demand is not very cyclical, the prices still can be. And so Alcoa, here on Wikipedia, we can see it's the 8th largest producer of aluminum in the world, conducts operations in 10 countries. It's a major producer of primary aluminum, fabricated aluminum, though it's active and growing participation in all major aspects of the industry: technology, mining, refining, smelting, fabricating, or recycling. So Alcoa is an aluminum producer. Um, I would give this company, let's say 3.5 stars for industry. This is a good industry to be in. It's an industry whose demand is certainly not going away. Obviously, since Alcoa has been around doing more or less the same thing since the 1800s, that really evidences how stable this industry is. And despite any short-term fluctuations in aluminum prices, in Alcoa's profits, nonetheless, this is a very stable industry. It's certainly an inflation resistant industry, which is very important, as illustrated by the last few years and what the value of money has done over that time. And so we're going to give Alcoa 3.5 stars for industry. Moving on to price, we're going to look at a few different price metrics to get a picture of how expensive or cheap Alcoa is on the basis of price. Now, of course, companies can be very highly priced based on their price multiples and still be a good value if the growth is there and the long-term trajectory is there. Alternatively, a company could be valued very cheap, and if anything, that could be a sign that it's not growing or that its future is not bright. And we'll get into those factors in later categories that we go through, especially the growth category, the financial position category as well, meaning how strong the balance sheet is and how solvent the company is, or if it's at risk of bankruptcy or having to dilute shareholders. We're going to get into all of that. But for right now, we're focused on the price category. So we're just going to be looking at what are the price multiples of this company. Does it look expensive or cheap based on how its price compares to its earnings, its book value, and similar metrics? And so let's dive right into it. Well, first of all, let's take a look over here at using Seeking Alpha's tools, which are very helpful. We see that the company's market cap, meaning the total value of all the shares outstanding, is 5.93 billion, so almost $6 billion, and that's going to be the price part of the price multipliers. So for example, the price to earnings, to calculate that, we're going to take the company's total net income and we're going to divide the price by its net income, price to earnings. So the price is 5.93 billion. That's how much you would have to pay to buy all the shares of the company at its current price. And so now let's move over to the financials, starting with the income statement. So let's take a look at the price to sales ratio. And the price to sales ratio is the price divided by the annual revenue of the company. So, on a trailing 12-month basis, meaning the last 4 quarters that were reported, this company, Alcoa, has 10.7 billion in revenue, and so we divide 5.93 billion, which is again the market cap of the company. We divide it by 10.7 billion to get the price to sales ratio, and we are going to come out at a price to sales ratio of 0.55. That's actually a very low price to sales ratio as these things go. Now, of course, as we can also see here, the gross margins of this company, like for many commodity businesses, are very low and have actually gotten lower in the last few years. And so, this gross profit, which is the total revenue of the company minus the cost of revenue or the cost of goods sold, which means how much did they have to spend just to produce that revenue, not counting other expenses down here like marketing and administrative expenses and employees, but just to actually produce the aluminum and other services that they sell. How much do they have to spend? And so, as we can see, not a very healthy gross profit, but nonetheless, and that's why the price to sales ratio for companies like this are going to be pretty low, because there's not too much of that revenue getting down into the lower figures on the income statement. But be that as it may, the price to sales ratio on its face is pretty good at 0.55. Now, scrolling down to the company's net income, we see that they actually operate at a loss, um, and they have been operating at a loss for the last several years. That is not a good sign in terms of the value. We do see that in 2021 they did have a decent profit, but other than that, for the last 6 years they've been bleeding cash. Even going back farther than that, it does not look good. Since 2014, they've only had a handful of profitable years. They've lost a lot more money on the bottom line than they've made, and that is certainly going to factor negatively into the price calculation for this company. Now, moving on to the free cash flow statement. Let's see. Obviously, this company is not consistently profitable at all. If anything, it's been losing more money than it's been making. But let's see whether Alcoa has managed to generate free cash flow, meaning that the cash that they've derived after all is said and done from their business, whether they're taking positive cash flow in or whether there's negative cash outflows leaving the business. And so we can see here, on a levered free cash flow basis, things actually look really good. And so they've been consistently profitable on a free cash flow basis. That's kind of unusual to see a business that, you more frequently see companies that have a positive net income and negative free cash flow. Here we have a company with mostly negative net income, but consistently positive free cash flow. And so taking this figure for the last 12 months, 716 million. What we're going to do is we're going to plug that into our calculator, divide the price, which again is 5.93 billion. We're going to divide that by 716 million. What we get is a price to free cash flow ratio of 8.28. That's actually really good. An 8.28 price to free cash flow on a trailing basis, that's quite low. A single digit price to free cash flow ratio is very attractive. And so that's going to help out Alcoa in our rating on the price front. Now, let's just look at the balance sheet as well in order to more fully determine whether this company has an attractive price relative to the net asset value that investors are essentially buying when they buy this company. And so we see they have about $1 billion in receivables, a little over $1 billion in cash and equivalents, inventory close to 2 billion. So their total current assets are about 5 billion. Total assets overall are about 14 billion. Goodwill and other intangibles are zero. So we can see that the total equity is $5.4 billion. That is actually very close to the market cap. And so Alcoa actually looks really good on this basis. If we just do the math, 5.93 billion divided by 5.41 billion, and then we're going to get the price to book price to book ratio of 1.1. So this company looks really good. It's trading at only a tiny premium to its book value. And so, just to recap what we've seen here, we've seen that the price to sales ratio is quite attractive. However, the price to, to the gross profit is not nearly as attractive. Price to earnings is negative almost consistently. Price to free cash flow looks quite attractive. And then the price to book value looks quite attractive as well. And so, overall, for price, we're going to give Alcoa a rating of 3. Not really sure what's going on there with the net income, why it's negative, while the free cash flow is positive. And that's certainly going to take at least a point off of this, because if those earnings looked like the free cash flows, then I think we'd be able to assign probably easily a 4-star rating on price. But because of those negative earnings, we're gonna have to give Alcoa 3 stars out of 5 when it comes to price. So now moving on to growth, let's take a look back at the income statement to see whether this company is growing, how what kind of rating it should get there. Now, as we can see here on the top line, revenues since 2014 have been down significantly. They peaked in 2018. It looks like at 13.4 billion annually, been trending down. And this is often what commodity based businesses look like on their income statements, very inconsistent numbers. And the reason being that, the prices fluctuate. And so, with all of that said, this is not looking fantastic from a growth standpoint, to say the least. Now going to net income, as we noted, net income has been negative, hasn't really been on any consistent trend of either growth or contraction, and so we're gonna again say this looks not the best, to say the least. And then lastly, we'll just look at the free cash flow, which, as we saw, is positive. Has it been growing? And so in the last few years, it's definitely been growing. 2021 looks like was the peak here at almost 1.7 billion in free cash flow. But again, not any consistent picture of growth. The last few years have been growing, but other than that, it's been very inconsistent. And so lastly, let's just look over at the the earnings estimates from analysts for this company. And again, Seeking Alpha is very helpful here. We're just looking at what do analysts think in terms of revenue and growth for the next few years. And so we see that analysts expect profitability over the next few years. This is probably on a non-GAAP or adjusted basis. And it could be that this company has been profitable on a non-GAAP basis. It's very likely, considering they've been free cash flow positive. But we're focusing on GAAP numbers for the most part, but the analyst estimates always take into account non-GAAP numbers. And so for this year, it's looking like 92 cents is what analysts are expecting. 2025, they're expecting a big 170% jump to 249. 2026, we're supposed to get a little bit of further growth to 266. Turning to revenue, revenue is expected to rise from here. 2024 this year is expected to be a 7.5% jump from last year. 2025 is supposed to tick up a little bit over 1%. 2026 is supposed to be roughly stable from 2025. Now, analyst estimates should always be taken with a grain of salt, but especially in the case of a company like Alcoa, where the future is very, very tough to predict because, as we've seen, revenues and profits and cash flows vary a lot from year to year based probably on the price of the commodity that they're selling for the most part. And so, let's take this with a grain of salt, but still take it into account. The future growth numbers, especially on the earnings front, look a lot better, according to analysts, than the past has looked. And so we'll take that for what it's worth. So, with all of that said, to recap on the growth front, we've seen revenue, earnings, free cash flow, very inconsistent growth, if growth at all. For the most part, we've seen revenue contraction. The analyst estimates do offer a little bit of hope on that front, but all of that said, we can't take that too seriously. And so, from a growth standpoint, we're going to have to give Alcoa two, let's say 2.5 stars. We'll give them 2.5 stars, taking the analyst estimates into account. Otherwise, it'd probably be 2 stars, because it's not like they're shrinking dramatically, but definitely you'd like to see growth out of any company over the long run. And we haven't really seen that out of Alcoa, but we'll take them up to 2.5 stars here on the growth front based on the little bit of weight that we do give to analyst forecasts. So now turning to financial position, we go back to the financials, back to the balance sheet, and we just want to see how strong is this company's financial position. Is this company at risk of going under? Does this company have a strong balance sheet to ensure the security of its operations, to ensure that it's not going to have to take out a bunch of new debt or issue a bunch of new shares and dilute shareholders? So, from the balance sheet standpoint, let's first look at the current ratio. That's the ratio of current assets, meaning assets that are accessible within the next 12 months, as opposed to long term assets. Current assets are 4.9 billion. Current liabilities are 3.16 billion. That's a pretty healthy ratio, getting up there. It's not quite at 2, which is the number that we'd like to see, but it's close. Rounded to the closest digit, it would be 2, and so that's pretty good. Moving on to long-term debt, we want to see right here, not too much debt, 2.46, 2.47 billion, not too bad, especially compared to the free cash flows, which we saw, averaging a few hundred million a year. And so they could pay this off, within 5, 6 years, probably based on estimated annual average free cash flows. So not too terrible. Also compared to the market cap, it's not too bad, and compared to the assets on the balance sheet, it's also not too bad because, as we've seen, they've got 2.47 billion in long-term debt, but if we scroll up, we see they have double that amount in current assets. So that's a pretty good sign. They've got more than half that amount just in cash and equivalents. So that looks pretty good as well. Looks like they're in a pretty strong position, probably not at risk of going bankrupt anytime soon. So we see here they've got an interest expense of 121 million, on, as we saw, about 2.7 billion of debt. Not too bad. That's a low single digit annual interest rate. And it's very easily covered by the company's free cash flow, although, again, not by its net earnings, as we saw. So, on financial position, I'm going to give Alcoa 3.5 stars. It can't really do better than that because they do have, a nice chunk of debt as compared to earnings, especially their earnings being negative, their free cash flows being inconsistent. It would take a bunch of years to pay off their debt out of their free cash flows. And so we'll give them 3.5 stars because everything else, other than those ratios of debt and interest to income, everything else looks good on this front. Good current ratio, not too much debt. Good ratio of cash to, cash on hand to debt, and so they'll get 3.5 stars for financial position. Lastly, moving on to management, which is really the toughest thing to rate out of anything. because we can't really look at the numbers so much, although we're going to try to look at certain numbers that maybe indicate how management is doing. And so, first of all, using another one of Seeking Alpha's tools, let's scroll up here and look at how is this company faring versus its forecasts. So we can see that they've beat on earnings 5 times in the last 2 years. They've missed 3 times. So these are the quarterly results for the last 2 years. They've beat EPS estimates, analyst estimates for earnings per share 5 times. They've missed 3 times on revenue. That's reversed. They've beat 3 times. They've missed estimates 5 times. That's not so good. That shows that about half the time they're missing estimates. You'd like to see this number higher in terms of surpassing estimates, because that would show that the management team is doing a good job of under promising and over delivering. And we don't really see that here. Moving on to insider transactions. So we can see here that in the last 12 months, management has purchased 426,000 shares and has sold 120,000 460 shares. So that's a really good ratio. The net activity here is that they've purchased 305,000 shares of Alcoa. And that is a good sign. That's a sign that the management team is very much optimistic about how things are going for this company and believes that the company is undervalued in all likelihood. The fact that they're putting their own money behind buying shares is a very good sign for this company. Let's also just check really quickly. Do they pay a dividend? I would think and hope that they would, because they are a commodity based company. However, they have negative earnings. So um, they do pay a dividend here. It is a small dividend, 1.21%. And so that's something that goes to, management being willing to return capital to shareholders. I'm not really going to fault them for not having a higher dividend rate than that, for the simple reason that, as we've seen, their reported GAAP net earnings are negative. So let's take a look at share count and dividends. We just saw dividends. So in terms of the share count of this company, we can see down here diluted weighted average shares outstanding. The number has remained relatively stable over the last 10 years, and that's a good sign. It shows that management's not diluting shareholders, not issuing a bunch of shares to themselves. At least if they are, they're buying back shares as well. But this looks pretty stable. You just really want to see that the share count is not rising significantly. Since 2021, the share count has actually come down a nice amount by high single digit percentage here, from 190 to 179. That's, I would estimate, about 6% reduction in less than 4 years. So that looks really good. Not the best over a 10-year period. It's come down marginally, but again, as long as this number is not going up, they're already on the right side of this number. So based on the really good pace of buying back, of reducing the share count, or at least not letting the share count rise, as well as the fact that um, they've been buying shares, the insider transactions look very favorable in terms of management's outlook for this company. So those are really good signs. However, the performance versus forecasts, and the earnings surprise numbers are not good. We're going to give them 3.5 stars for this category. So now for the blended score, the total score for this company. So to recap, for industry, we gave Alcoa 3.5 stars. For price, they got 3 stars. For growth, 2.5 stars. Financial position, balance sheet looked pretty good. They got 3.5 stars. And then the management team also looking pretty good at 3.5 stars. The average rating among these different categories is 3.2 stars. That's the rating for Alcoa. Total rating 3.2 stars. Again, nothing in this video is financial advice. No buy or sell recommendation is being made here. I personally have no position, whether long or short, in Alcoa. This is all provided for informational and educational purposes, not advice. Thank you so much for joining A to Z Equities for another video, and we hope to see you back again in the near future on another video. Thank you.